Tesla has been the subject of a lot of attention and criticism over the past few years, but it's hard to argue with the results. The company has come a long way in a short amount of time, and anyone hoping for Tesla-like profits when investing should probably try and invest in a company with similar characteristics. Things to pay attention to include that the company serves a mass market, has potential to make a large profit, and has potentially revolutionary ideas, while being somewhat of an underdog, with the stock not being too popular at this point, but still having a positive momentum. With that in mind, we compiled a list of 10 stocks that might have the potential to be the next Tesla. Everyone knows Spotify, the streaming music service that is one of the largest of its kind, with over 345 million monthly active users, including 155 million paying subscribers as of December 2020. Spotify definitely addresses a growing mass market, and it has a healthy stock chart, but unlike Tesla and others on our list, Spotify is not exactly revolutionary, and it is growing a lot more slowly. At $7.9 billion, total annual revenues were up just 18% in 2020 from the year before. So while Spotify continues to grow, the company doesn't show as steep a growth curve as Tesla and some other companies on our list. Zoom Video is one of few companies that profited hugely from the pandemic, as people all over the world suddenly saw themselves stuck at home and having to do a lot more video conferences. Like Tesla, the company also caters to a mass market and has the potential to revolutionize it, while it has also shown that it's capable of big earnings, with the fourth quarter of 2020 seeing revenue of $777 million, up 366% from the year before. The stock is up more than 200% in the last year, as people not only used Zoom Video for work-related conferences, but also had socially distanced and virtual get-togethers with friends and family. Everyone knows and loves Zoom, which is why the stock has more than tripled since the pandemic started, and that seems to be the only thing the stock doesn't really have in common with Tesla, since the high public opinion definitely makes Zoom much less of an underdog than Tesla. Tesla is the most successful electric car manufacturer in the world, but at the same time really expensive at a trailing PE ratio of more than 1,000 times. In this regard, electric vehicle infrastructure company ChargePoint Holdings is a lot like Tesla. ChargePoint operates the largest online network of independently owned electric vehicle charging stations operating in 14 countries, and the company also produces the technology used in it. According to its own data, ChargePoint offers its customers more than 132,000 places to charge across North America and Europe, which is 7 times more than Tesla offers, and makes ChargePoint the global market share leader in electric vehicle charging. Yet, their huge network still only netted ChargePoint $146.5 million in sales in 2020, and actually cost the company $197 million in losses, resulting in a stock valuation of 45 times sales. Valued on price to sales, ChargePoint is actually twice as expensive as Tesla already. This isn't exactly a great thing, but it does mean that, like Elon Musk's company, ChargePoint can use their highly valued stock as currency to acquire and roll up competing companies, to raise funds to build their own network, and to avoid having to take on debt. However, it remains to be seen whether things are going to play out for ChargePoint like they did for Tesla, or whether the stock is simply greatly overvalued and doomed to crash eventually. Fisker Inc. is the 2016 relaunch of the American Fisker brand previously known as Fisker Automotive, which produced the luxury plug-in range extended electric sports sedan Fisker Karma. Today, the company focuses on solid-state battery tech, a growing alternative to the lithium-ion batteries that most EVs depend on. While these batteries are more expensive than the older lithium-based systems, the big advantage is that solid-state batteries are safer and offer higher energy densities. The company is currently developing the Fisker eMotion, an all-electric sedan that will have a 400-mile electric range, and a mass-market electric vehicle SUV called the Fisker Ocean. In addition to designing and developing the electric vehicles, Fisker has also filed patents pertaining to solid-state battery technology for use in automotive, consumer electronics, and other industries, a solid strategy to lock in its advances in the field. Since solid-state batteries not only offer faster charging times, but also a longer range per charge and potentially lower battery weight, they are obviously very interesting for EVs, as these are all important factors with great influence on vehicle performance. Fisker only entered the public markets through a SPAC merger agreement in the fall of 2020, and following the completion of the SPAC transaction on October 29th, shares in FSR were up 112% by mid-February. Fisker's stock has been volatile though, being nearly double for the year as of early March before giving back most of those gains in the following weeks. It's impossible to say for sure whether Fisker will see the sort of run Tesla had over the past 3 years, but the asset-light model, if successful, offers Fisker the opportunity to generate strong returns without huge investments in plants, supply chains, and workforce. Founded in 2014, Chinese automobile manufacturer NIO is still in its early days, but saw its share price skyrocket last year as its shares went up an unbelievable 1,240% over the course of 2020. The Chinese EV company is Tesla's biggest competitor, and it is taking on the Chinese EV market in a big way. The company has similar ambitions to those of Tesla, which is why it's often compared to the US company, with investors hoping that NIO will one day become sort of like the Chinese version of Tesla. After a rough start following its IPO in 2018, NIO has been on the rise, producing vehicles with record-breaking range, and about a year ago, no one could have imagined how well 2020 would turn out for NIO. In fact, rumors were circulating that the company was on the verge of going bankrupt, and both investors and analysts were ready to give up on the Chinese automaker. But NIO pushed on and ended up blowing all estimates and managed to keep its balance sheet in line. After reporting a record number of deliveries, launching its revolutionary battery-as-a-service platform, and receiving a multi-billion-dollar bump from Chinese investors, the company's share price shot up from $3.24 at the start of 2020 to a high of $61 in February 2021. Representing a massive 1,600% return for investors who held on to their shares despite the bankruptcy. NIO is still a fairly young startup company and isn't even profitable yet, but it's only a matter of time until the company will turn a profit. The company already announced that its sales had more than doubled by the fourth quarter report in 2020, and even greater sales are to be expected in 2021, while CEO William Li will make sure that NIO will continue its upward trend through 2021. Taking Mr. Tesla's first name, Nikola is a Utah-based startup company that plans to build electric semi-trucks powered by hydrogen fuel cells. In theory, the idea has a lot of advantages, but the challenge remains to prevail in the fossil fuel-centric industry. However, there's been a lot of interest in the Tesla's Cybertruck, and Nikola has started taking reservations for its own non-hydrogen electric pickup truck as well, as this one has a far more conventional design than Elon Musk's futuristic-looking vehicle. The company only went public about a year ago, and while there was some serious buying going on last May and June, the stock's initial strength has completely vanished. The comparison to Tesla seems to be an obvious one due to the company's name and product, but Nikola still has some major obstacles to overcome, including the fact that it doesn't have any revenues yet. The company is fairly unknown so far, but it could still turn into a success in the future. If all goes according to plan, Sir Richard Branson and a few paying passengers could be on their way to space with the first flight by Branson's company Virgin Galactic Holdings. The company's long-term goal is ultra-fast transcontinental travel, like New York to Tokyo in 2 hours. And while there are obviously some major obstacles to overcome first, the company certainly has revolutionary ideas. Thanks to being well-funded and having experienced management, Virgin Galactic Holdings has big potential. Despite the stock crashing down in March to under $30 from its peak above $59 in February, it is still up from where it started this year and has somewhat stabilized over the past few weeks, so this might actually be a time to buy the stock. Roku Inc. manufactures a variety of digital media players for video streaming, and their devices have been considered influential on the digital media player market, as they helped popularize the concept of low-cost, small-form-factor set-top boxes for over-the-top media consumption. Roku's digital media players enable the playing of content from any provider on any device, and as the mass market is global and growing, Roku has also seen a lot of growth. Revenue growth was up 58% in the fourth quarter of 2020, and has been getting better and better. The company is neither especially liked nor disliked by the public or investors, but the stock has more than tripled over the past 12 months and continues to have positive momentum. Teladoc Health, Inc. is a US-based multinational telemedicine and virtual healthcare company that provides on-demand healthcare services over the internet. The service is revolutionary in an industry that was in desperate need of innovation, and as a result, Teladoc has seen accelerating revenue growth. Looking at the full year, the company reported annual total revenue of $1.09 billion in 2020, a 98% increase over 2019's $553.3 million. This means that Teladoc is growing at an increasingly fast pace, which presents quite the challenge for analysts who struggle to adjust their estimates upward fast enough and that make it a stock that offers the potential for some Tesla-like profits. Curaleaf is the biggest marijuana company in the US, and it's likely to remain the leader in this market since the barriers to entry in the industry are not technical but regulatory. Total revenue for the year 2020 was a record $626.6 million, an increase of 183.5%. This was thanks in part to the acquisition of Grassroots, and the company is expected to have positive earnings in 2021 as well. The marijuana sector has seen an explosion in stock prices, though it recently started to pull back. Despite serving a mass market, and a growing one at that, the company is still fairly unknown. Similarly to Tesla, investors don't really love the stock, and with around a third of Americans still not in favor of legalizing the industry in the first place, Curaleaf seems to show a lot of potential to become the next Tesla. Be sure to comment down below and let us know if we've missed something. Hit that subscribe button and turn on the bell to never miss an upload. Thank you very much for watching.